All right, last lecture on inventory. This one's not going to take very long at all. So we'll just kind of jump right into it. For me, this is going to be really conceptual. If you continue in your accounting education, at some point, you will get, a lot of more technical experience as far as covering these concepts, and honestly, it can be pretty heavy. But for now, we're just going to kind of keep it very conceptual. Anytime there's a change in inventory method, if it's voluntary, you do have to report that retrospectively, which basically means you have to restate prior years as if you were using the other inventory method. So let's say you've been using LIFO for the last 5 years, and all of a sudden you say, "Hey, I'm going to switch to FIFO. I'm voluntarily changing to FIFO." You have to go back all the way 5 years and say, "Well, what would my ending inventory have been under FIFO? What would my cost of goods sold have been under FIFO?" And then kind of carry that all the way forward through every year up until obviously the present year when you're going to use the new method. And so it's changing inventory methods is no small thing. Um, Whenever you do that, you're going to be restating those prior years. And so your income statement is going to change because of cost of goods sold. Your balance sheet is going to change because of inventory. And then retained earnings, obviously, because cost of goods sold is close to retained earnings. Your retained earnings is going to change too, and that's going to accumulate over time. Every year the cost of goods sold is going to change that income, and that's going to accumulate as a change to retained earnings. So that's again, you're going to see it show up in your financial statements. And then you're likely going to have a journal entry because at a minimum, you're probably going to have to change your inventory balance and your retained earnings balance. But beyond that, you're probably not going to have to touch cost of goods sold. The only time you might is, let's say, partway through the year you switch from LIFO to FIFO or vice versa, or whatever it might be. Whatever you'd record as cost of goods sold to date, you'd have to restate using the other method. But outside of that, you're probably not going to touch cost of goods sold. And then inventory errors, much like changing method, very conceptual here, but when you make an error, again, a lot of things going on, you got to make a lot of changes to what you've presented. You do have to correct the error. In other words, if you discover a material error, you have to correct it. You don't have a choice. Usually the error is found before the financial statements are published. So somehow in the review process, you figure out, wait, I think we missed something, and you fix it. And so honestly, not a lot to do other than maybe a journal entry potentially. Or a lot of times you might catch it within a year. It usually isn't going to go multiple years. And if it's just within 1 year, a lot of times the change or the correction is minor. If it goes undiscovered for more than a year, then it gets a little ambiguous about what's going to go on. And we'll kind of talk about why that might be the case. But it really does depend on the nature of the error and when you discovered the error. All right, so how does this all affect? Again, whenever you do a physical count, it's going to touch your inventory balance, which is also then going to change what you infer about cost of goods sold. So, any error in physical count is going to create an error both in the inventory account and in cost of goods sold, ultimately in retained earnings. And then as far as what's beyond that, it kind of depends a lot on timing. So let's kind of go through this example. And so let's just say that, it's 2023 and I mistakenly overestimate or overstate my ending inventory. So I count some items that I should have counted, or I double counted some items, whatever it is, I overstated my ending inventory. So just because cost of goods available for sale equals ending inventory plus cost of goods sold, if I have an overstatement in my ending inventory, I will have an understatement in my cost of goods sold. They directly offset each other mathematically. If I understate my cost of goods sold, that's going to show up on my income statement. So if I have a lower cost than what I should have, then my net income is going to be overstated. And since net income gets close to retained earnings, that means my retained earnings is going to be overstated. But here's the issue. If I don't discover the error until well into 2025 or what, until into 2025, the beginning error or the ending error that I had in 2023 is also going to create an error in the beginning balance of 2024. So now my beginning inventory is overstated. In other words, I think there's more inventory there than's actually there. And let's say then I do my physical count at the end of the year and I actually get that right. I do that correctly. Well, what am I going to assume happened to the $800,000 of inventory that wasn't there? and isn't there now? Well, I'm going to assume that I sold it. And so that overestimation in the beginning inventory is going to create an overstatement of our cost of goods sold number in the following year. That overstatement of cost of goods sold means now our net income is going to be understated for 2024 in the following year. But because retained earnings accumulates the error, the overstatement in 2023 will be offset by the understatement in 2024, and the retained earnings will be corrected. So if I get into 2025 and I discover the error, there's no journal entry because my ending inventory balance is what's going to carry forward into 2025. That's correct. My retained earnings is carried forward. That's correct. Cost of goods sold is closed. So I don't have anything to correct there. So if I discover the error in 2025, there's no correction necessary. So again, it's called like a self-correcting error. And so just as a concept, this is the example in the book, just as a concept. Let's say that I had made a mistake with my net purchases. So my inventory counts were okay, but my net purchases were incorrect. If I were to make that mistake, what's going to happen is my cost of goods sold will be incorrect. If my cost of goods sold is incorrect, it means my net income is going to be incorrect, which means my retained earnings is going to be incorrect. And here's the implication for all of that. If my retained earnings is incorrect, there's really nothing in future years that's going to correct that because the net purchases, it gets all closed out. It's all closed out as part of your retained earnings. So there's really no, in that case, um, there's no correction. And so you're going to kind of permanently have an error in your retained earnings number. And so unless you discover it, it could basically forever be incorrect. So again, that's one because your ending inventory count is correct. That gets carried over. And so in that case, there's not a future error other than your retained earnings balance is going to still be incorrect. All right, so any inventory would be incorrect, cost of goods sold would be incorrect. I'm sorry, any inventory would be correct, but cost of goods sold would be incorrect. And again, with the inventory, there's no carryover into 2024. All right, that's it. Well, hopefully good. You study hard and do well on the test. Thanks.